Welcome to the last video on cost of capital. We now look at cost of preference shares. The preference shareholders will receive a fixed income based upon the income value of the shares held, not the market value. These dividends, which are received by the preference shareholders, whilst fixed and hence showing debt characteristics, are paid out of post-tax profits and therefore do not receive tax relief. The formula for computing cost of preference shares is given as Kpref equals preference dividend divided by market value xdiv, or D over PO. Again, take note that this formula is not given in the exams, so you need to memorize it. We apply it in the question. A company has $100,000 12% preference shares in issue. The nominal value of these shares is $1. The market value today of the shares is 1.25. A dividend has recently been paid and we are required to compute the cost of preference share capital. You simply again replace in the formula, which we saw as DO over PO, DO being the preference dividends. The preference dividends you are given there as 12%. The market you are given there. Again, you change the measures to the same unit of measure, to cents, substitute and calculate, you get 9.6%. Some questions may also give you a loan, so you may be required to compute the cost of bank loan. The cost of bank loan will be given by the examiner, but all you simply need to do is you multiply the cost given in the question by 1 minus t, so that you get rid of the tax to leave you with the post-tax cost of bank loan. When all these different costs have been computed, these are then replaced into the weighted average cost of capital, which gives us this cost of capital that we started with. So the weighted average cost of capital, or the WACC, is a makeup of different cost of finance. Though the formula is given as WACC equals VE over V plus VD in brackets multiplied by KE plus open brackets VD plus over VE plus VD close brackets times KD minus the tax shield. If there are more than two sources of finance, some questions will give you 3 sources of finance, then you need another one of this to be added this side. So you need another plus. For example, if you've got preference shares, so you need another plus VPref divided by VE plus VD plus VPref. So it means at the bottom here you'll be adding 3 things, not 2 things. If the question has given you 4 sources of finance, then you'll be adding 4 things at the bottom, and then you're going to have another 4th addition at the end of this formula. Take note that the VE should be market values, xdiv. The VD should also be market values, x interest. Unless the question specified that you use book values, please remember you always need to use market values. We'll practice this now in the final question of our study. So we're given in this question the ordinary share capitals of nominal 50 cents, 2.5, 12% unsecured bonds 1,000. The ordinary shares are currently quoted at 130 cents each, and the bonds are trading at $72 per 100 nominal. The ordinary the ordinary dividends of 15 cents have just been paid, with an expected growth rate of 10%. Corp tax currently 30%. Compute the work. So how many sources of finance we've got? 2. So formula will not need to be modified. So substituting in the formula, remember we said the book values, you are given book values of the ordinary shares and the book values of the bonds. These we need to change them to market values. So the ordinary shares are currently quoted at 130 cents, while the book value is, the nominal value is 50 cents, and the book value is 2.5, whereas the bonds, the book value is 1,000, but they're trading at $72 per 100 nominal. So changing this to market values, for the equity we need to get the number of shares. To get the number of shares, which is a figure hidden somewhere here, you divide this divided by that to give you that, because when you multiply this figure hidden here times that, you got the money value there. So the number which is hidden here, which is the number of shares, please remember the examiner always hides the number here, which is the number of shares. You need this number of shares before you can convert this number of shares to market values. So to get that, you divide 25 divided by 0.50 here, because it's in cents. That's when you multiply with the market value of 1.130 cents to give you the market value, which is 6.5 million. The bonds, you've got a nominal of 100, but they are trading at lower than the nominal. They're trading at $72. So you simply divide 1,000 divided by 100 times $72 to give you 750. You add the 2 to give you the market values, the total market values of the debt and the equity and the bond. Then we need KE. We're given the ordinary dividends there. We're given the growth rate there. We know the market value, so we can use the dividend growth model to compute our KE. So substituting in the dividend growth model formula, we get our KE as 22.69%. We also need our KD we go back to the bond there. The interest is there. We know the market price for the bond. Substituting, we get our KE as 16.67%. We now have all the variables we need to substitute in the work formula. So substituting in the work formula, we now get our weighted average cost of capital or the work of 21.56. That brings us to the end of cost of capital lecture. Extremely important topic in financial management. I cannot overemphasize. You do well to listen to this video over and over. Once you have listened through the video lecture, do not end there. The SCCA website has a lot of questions which you could use to practice. Also, they've got the solutions on the website for the questions, so you're able to test yourself, practice the questions, and see whether you've understood the concept. I cannot overemphasize. The examiner really loves this part of the study, especially in section C as a full question, where you have to go through the different components of the cost of financing that we've done, which culminates into the work. You may also you will certainly find in the multiple choice questions also different short computations of the cost of financing, either cost of debt, cost of equity, using the different formulas that we have gone through this video lecture. So I urge you, finally, as we conclude, find time to go through the video not once, twice, at least 3 times. Then find questions to practice and practice and practice. Thank you for listening. Be looking forward to the next video for another study. Thank you.